Money. Money.
Today, my money chat's around for my first-time home buyers. Any of you listening to the show that are currently renting and thinking about being a first-time home buyer, I just want to go over a few things to make sure that you don't make these mistakes that some first-time home buyers are considering to be a home buyer might make. The housing market is hot thanks to the still historical low interest rates and the lack of inventory. And some big mistakes that first-time home buyers can make. First, not considering purchasing and continuing to rent. So it may seem a little bit overwhelming in the idea of being a homeownership, but the best thing to do is to run the numbers. To do that is to consult with a mortgage consultant. That's what I do for a living full time. So if you need my assistance, I can help you there. Looking at the numbers to really see what the benefit is of homeownership versus rent. So if you're making a rent payment, remember that mortgage payment is completely different because of the benefit that you have through tax benefit, possibly tax credit if you qualify for those. So you do get an interest deduction. If you're in a 25% tax bracket, every $100,000 that you borrow, that may be around $70 a month that you're receiving a benefit in your income taxes. So that's less income taxes you're going to pay at the end of the year. If you didn't know, you can actually amend your W-4 with your employer so that you can see that money on a monthly basis in your net income rather than waiting to the end of the year to take that benefit. Also, there are first-time tax credits available for first-time home buyers, 20% tax credit on all the interest that you pay on your mortgage for the life of the loan, dollar for dollar. So that's in addition to the deduction that you have. Now, homeownership also, you have the equity that you're paying down mortgage. So every time you're making a mortgage payment, a portion of that's going towards your principal. So that's equity. That's just money that you're building up in your home and have access to you when you sell that property. Plus the appreciation that you have in your home when your property increases in value. Now, homeownership also is a fixed rate. So your majority of you would be looking at a 30-year fixed rate mortgage. So outside of your property taxes, homeowners insurance, those are going to fluctuate. The mortgage is going to be fixed for 30 years. If you look at your rent, average increase in rent on an annual basis, maybe 4 to 5%. So the difference between having a fixed rate versus a payment that you don't know where it's going to be and with no end in sight. And then the last thing when it comes to really running the numbers and considering it is if you look at a mortgage, eventually, at some point in time, that mortgage is going to be paid off if you're on a 30-year fixed rate mortgage and you're not continuing to buy up in your property, whereas rent is a never-ending payment. Now, also, you want to make sure that once you get into a home that you're not using that home as an ATM. You are going to be building equity, so you can get home equity lines of credit to pull money out of your home. And that's fine if you're strategically doing smart things with it. If you're taking the money off to pay off credit card debt and not building more credit card debt, or if you're taking money out to do improvements on your home so that you can build the value because of the work that you're doing on the home, and making sure that you actually can afford that additional payment that you're going to have. So just be cautious there in not using your home as an ATM. Put the cart before the home. Make sure that you're getting pre-approved. Run the numbers when you're looking at the numbers, making sure that you're finding out what you can actually approve for and know what your options are. There are a lot of different loan program options, analyzing all of them to make sure that you're picking the best program. You want to do this before you actually get out and start shopping for a home. So really get prepared on that and make sure you know where your objective is in your payment. Now, the bank is going to approve you for the very maximum. You also want to know where your own comfort range is and where you're willing or not willing to stretch that payment. So when you get out in the market, you're ready to go. Not preparing to compete in the market is a big one, especially with the lack of inventory. So this is a big mistake, not just only first-time home buyers, that anybody that's getting into the market that doesn't understand exactly the dynamic of what's happening. You've got to be ready to move quickly. If you want to get that home, be prepared up front and how to strategize and put that offer together by listening to what your real estate expert is telling you need to do to be competitive. Be prepared maybe with escalation clauses, potentially waiving inspection. I'm not saying not to get inspection. Doing a pre-inspection might be a good idea. Again, you can talk to your real estate expert on that. Come in with a strong closing. You want to be competitive there, so make sure your lender is able to close in a 30-day closing window, and that'll make you competitive when it comes to closing. Possibly look and talk to your real estate expert about waiving your finance contingency, just putting yourself in a real position to be competitive. And then also in possibly higher earnest money. Typical earnest money is anywhere from 1% to 3%. Now, right now in this market, I would say 3 on a high end would be 5% to be very competitive. That's money that's going to go directly towards the purchase of your home. So it's not money that is not coming back to you, but going towards the loan. There's a lot of other things that you can be competitive with. That's why it's important to work with a real estate expert that has knowledge of and works with a lot of buyers in negotiating so they can really help you to coach you in that area. To Faith Online, while many credit counselors and financial advisors advocate researching mortgage online, it's a good place to check with the area that you're in and see kind of what's out there, run some quick payments. But it's really important that you get with a mortgage professional that's local in your area and meet face to face. Everybody's individual situation is going to be different. It's a lot of money and it's a big option, and you want to make sure that you're taking time not to just use resources that are online. Although half of borrowers claim to grasp basic loan term and conditions, more than 2 out of every 5 bad experiences stem from misunderstanding over fees, terms, ownership cost, according to recent survey by PricewaterhouseCoopers. So it really does make sense to get with a professional face to face. And skipping the home inspection, I did talk about that and being competitive. Again, you really want to make sure that you're having an inspection to find out what that home potential issues are, the future of that home and what you're going to need to do to maintain the home and really get an idea of where that home has been and where the house is going. So is really important. Expect home values to appreciate in the short term. Now, I don't know what the market's going to do. We've seen a lot of appreciation in the short term, and we may see a lot more appreciation in the short term. But as a first-time home buyer, investing money into your home, you really want to be looking at this as a long-term purchase, because everybody knows what happened to people that purchased in 2006 and then were forced to sell in 2008. It wasn't a pretty picture. But what about the people that purchased in 2006, which was the height of the market, and went through the crash in the market, which happened in 2008, and they're still in that home right now? They're looking pretty sweet. They're surely a lot better than the people that were renting all the way through that process, because what happened? The market recovered. If you look at the history of real estate market, the market's always going to appreciate, but you're going to see the ups and the downs in the market. So you want to make sure that when you're selling your property, unless you're selling and buying up, you want to strategically plan on when you plan on doing that. So those are just some tips for my first-time home buyers. If you're thinking of getting into the real estate market, first and most important takeaway is get with your mortgage professional. Coming up next on the Money Hour, housing affordability and supply. Randy Banneker with Banneker Public Affairs right here on 1150 AM at KKNW after this short break.